One of the big themes for 2022 has been volatility. We've seen central banks act like they've never acted before. We've seen inflation rise to levels at a speed we've not seen in more than a generation. How's all this build up for 2023? Well, at IG, we thought we'd get together some of the big voices that we've got here amongst our team and talk together about what 2023 looks like. Let's start off with IG's chief market analyst, Chris Beauchamp, with his thoughts on 2023 and what he thinks the big trade's going to be. Chris.
If you look into next year, it's 2022 casts a long shadow, really, and it's the dollar that casts that shadow. It was the year the Fed moved into high speed with rate hikes, combating inflation or attempts to combat inflation. So it's an ongoing battle, and that really drove everything. It's not always the case that the dollar drives everything in market, but certainly 22 was that year. I think 2023 is the year when that starts to change, and the focus moves away simply from saying, "Oh, rates up," or pause on raising interest rates, and it moves into which assets begin to recover first, perhaps, from any recession that develops. So I think that's the key thing to look out for, and the FX market is that. And I think you do question whether the dollar can sustain its ascendancy into 2023 now that, if you like, not they've stopped hiking rates, but they certainly have slowed down their pace of hiking.
Okay, well, let's pick up on another angle to all this and off now to our Johannesburg newsroom and Shaun Murison, who talks regularly to clients and has opinions. And Shaun, what's your thought for 2023?
Hi, Jeremy. From our side, we're quite excited about what's happening in China at the moment. We are starting to see some, reversals in major equity markets, the Hang Seng and the Shanghai Composite, and obviously that is catalyzed by loosening of COVID restrictions within the area, and then we're also starting to see some support and increasing promise of support for the property sector, and obviously two major issues within the region, obviously stifling growth, and we think that could start to stimulate demand for commodities. Two of the commodities, in particular base metals, copper and iron ore, are ones that we're watching at the moment. There is a thought that copper could move into a deficit, and obviously that would bode well for underlying miners of those commodities. The major miners, of course, BHP, Rio Tinto, Glencore, companies like that.
Okay, Shaun, thanks so much indeed. Back with you in just a few moments' time. Josh Mahony joins us now here in London. Your thoughts on 2023, Josh?
Yeah, I mean, look, if 2022 was all about rate hikes, moving us from near enough zero up to probably 4.5% over in the US, I think 2023 is all about gearing up for the rate cuts. Previously, whenever you see a crisis, it's come out of nowhere, and then suddenly we've seen central banks essentially having to react very swiftly. So you don't necessarily see a massive run up for the rate cuts that we've seen in the past. And so previously, when we have seen rates cut, we've seen outperformance for the likes of gold. So that has taken on seemingly a haven role, because people think, well, whenever things are going bad, people head for gold. Why is it not the same this time around? Well, because this time we're seeing rate hikes into a crisis rather than rate cuts. But this time we also know that rate cuts are around the corner. So that is probably likely to happen maybe in 2024. But 2023 is all about gearing up towards that. Markets really do react ahead of time. So I'm expecting to see precious metals outperform. If you look at the previous two times that we've seen big rate cut phases, or actually three times, we've seen significant outperformance in terms of gold and silver. I'm expecting to see the same. We're seeing strength coming into the back end of this year. And I think 2023 is all about trying to understand when those rate cuts come and trying to get ahead of the curve for that next move higher for gold and silver.
Okay, Josh, thanks so much indeed. Let's now go to Axel Rudolph. Axel is, of course, a new member to the team and a specialist in technical analysis. But I know, Axel, that you have an opinion on 2023 and some big picture stories. What's your theme for next year?
Well, I believe that equity markets will actually start off the year on a positive footing, because if you look at the relative positioning of equities versus bonds, they're currently at the lowest level since 2009, according to a recent report from Bank of America. And we also saw some, as Shaun alluded to just a second ago, equity markets in Asia, in the US, and in Europe rallying by between 15 and 30% in the last couple of months. And I think that will push us into the beginning of next year on a positive footing. And then we'll probably see the data confirming that we might already be in a recession in these countries I've just mentioned, and that might then lead to a sell-off in equity markets again. So I guess it'll be a volatile year next year, but it could start off positively. And then if the downturn towards the end of the first quarter doesn't take us back to the lows we saw this year, perhaps we could end up on the year in positive territory in equities.
Well, let's try and bring all this together now and see if we can get some discussion going about how we interconnect all these stories. And I'm interested, Shaun, if I can, just to get the conversation going with you, taking into account what Chris was saying. But I think the big picture also takes in other metals as well as your idea of base metals. How do you see the dollar playing into your story, Shaun?
Well, at the moment, it does all start with the dollar, and we've started to see, that those major trends on the dollar, or at least in the short to medium term, changing direction. And that does bode well for commodity prices. When you see, that weaker dollar suggesting a bit more of a risk appetite returning to the market. So, rising tide starts to lift all shores, and that's good for, I think it's going to be good for the metals in particular. But then you have the added catalyst of, China economy getting going again. Growth has been stifled. It is opening up again. You can also argue that, with China, easing lockdown restrictions, and it's not without risk, of course, but with them easing lockdown restrictions, supply chains start to improve. And as you start to see supply chains start to improve again, it does also hopefully start to lower those future inflation expectations.
Axel, I want to quickly pop back into your thought process, because what Shaun was talking about there was some of the resource stocks that are going to do well next year. How does this play into the idea of equity markets, finding the opening quarter tough and then getting back into the swing of things later in the year? Is it the base metal companies that are likely to benefit most, do you think, from the rally that you're expecting later on in 2023 that could occur in equity indices?
That will likely be the case, but perhaps we will also see some tech stocks recover, simply because they've sold off so much, and therefore, from a percentage point of view, could rally more than other stocks, just to get back to some sort of normality. But either way, I think all the different sectors will be quite volatile next year, because I don't think we're out of the woods yet. Because if you look at this year's lows in October, those were made with a cash ratio which is pretty high in investment portfolios, at around still 25%. If you look at previous bear markets, that cash ratio rose to 40%. And also, if you look at stock allocations, basically, these were still around 60% in most investment portfolios. But at previous bear markets, these dropped down to 40%. So we haven't seen any capitulation in equity markets yet. And maybe that fear of this happening next year might lead to a lot of volatility.
That's an interesting word, fear. Josh, you're talking about some of the precious metals that play into gold next year. Quite often gold is it's a safety play, isn't it? People use it as an opportunity just to hedge against volatility, inflation particularly, and there's this fear idea. But at the same time, if money is going back into the equity markets, do you think that there is an argument perhaps possibly against this idea that we could well see a gold rally because money might be used elsewhere in the markets?
Well, look, I mean, it's interesting because sometimes when you're looking at correlations between different markets, you might say in the past, well, something like cryptocurrencies aren't particularly correlated to equities, and until you see markets crash, and then suddenly you just realize that everyone just sells out of everything when you're in the middle of a crisis. The same with gold, the same with silver. Everyone just wants to get out, and they half the time are trying to get money from one position to pay for another and alike. And so certainly, that essentially gets unwound on the reverse. I think, I just wanted to bring the conversation just back to this idea of, where we're going to look at in terms of markets and what's going to outperform or underperform. The FTSE 100 has done relatively well over the course of this downturn, and in part that's because of the fact that it has heavily reliant on, say, energy stocks that have done relatively well. So that commodity focus has boded well for the FTSE 100. Also, we've got the relationship with the pound because it's highly internationalized. And I think that what we've seen in terms of underperformance or overperformance for the FTSE 100 over the course of this year, where it's essentially been shielded from a lot of the losses because of the fact that we've seen cable move towards the downside. I think you're going to see the flip side in terms of the FTSE 100 on the way up. We're likely to see outperformance elsewhere. And as Axel alluded to, a lot of that for the US is going to be focused on the fact that we've got these tech stocks that by and large over the long term do outperform. And more recently, they've been absolutely hit hard. You're going to expect to see, I think, FTSE 100 underperform. I think we're likely to see a big focus once we do see markets recover heavily on the likes of the tech stocks, on the likes of US markets. And, whether it's, base metals or gold, I think we're likely to see outperformance. I think we're likely to see strength in terms of some of these markets, and that could help the likes of the FTSE 100. But all things aside, if you take away the effects of commodities, which have been working out very well for it, I think the FX considerations means that we're likely to see underperformance in terms of the FTSE 100 market.
That's a really interesting point. Talking to a financial advisor recently for a podcast I've just done for IG, talking about the US markets being ripe for an opportunity here, because it's likely that the US might come out of the mess, if you like, that we got, that Axel was talking about in the first quarter next year, first off. Chris, how do you think the dollar plays into all this? We've heard US companies in their earnings recently talk about the stresses and strains on their profit and loss because of and balance sheets because of the strong dollar. Is your base case, excuse me, that we're going to get a weaker dollar? And is that going to be one of the reasons why perhaps possibly maybe we could well see the US markets do better than most in the early part of next year?
It is possible. I think the slowing pace of those rate hikes, I think, means that a lot of the energy in the dollar rally has been expended. I suspect, really, we should never try and call a turn in a market, but you could make a case for saying, well, as the Fed perhaps doesn't move as fast, other central banks perhaps have to take over. We're looking most notably at the ECB and even the Bank of England, where because inflation is still showing signs of increasing in pace in Europe, whereas it's not in the US. So you could argue for that. Finally, maybe the euro gets some relief or more relief after its rally of the last couple of months and into 2023. It will at least be a cushion, I think, for US earnings next year, and that's probably the best we can hope for, I think, because the base case is still that some sort of form of recession arrives in maybe Q2 of next year, maybe into Q3, and yes, the weaker dollar will certainly help matters, but it won't cure it all of itself, I think. And if we're still working on the assumption that recession arrives, we don't know how deep it is. We do know, of course, that inflation in the US is so entrenched and at such as a high level, it's going to take a lot of effort to bring it down, and that risks a hard landing, a sharp recession, if you like, to avoid using too much jargon. So yes, while you might get a weaker dollar, that might help to an extent, and that might be maybe some of the first things the market latches onto for positivity, and thus leads to those sharp rallies that you might expect to see in another sustained downward move. I think it does provide only just the hope of a cushion bet. So sorry to sort of provide the gloomy view for the year ahead, but that is probably the base case we're working on at the moment.
I think it's interesting to note that what we've seen in terms of inflation over in the US isn't what we've seen in terms of European inflation. So if we see that gap widening, then what does happen if you start to see people want to get back into, say, the US dollar because maybe markets are suffering a little bit, but at the same time you're looking at maybe US inflation gets down to, say, 5%, but UK and Eurozone inflation is still double digits. Then that kind of weakens the story behind, sell cable, sell euro dollar. Maybe it makes people focus on some of these other countries, maybe Australia alike, where we see their inflation rates already well below. Because, obviously we have a lot more impact coming from what's happening in terms of Russia and Ukraine. We don't know when that's going to end, and we don't necessarily know if we're suddenly going to see, as we've seen here in London, a prolonged period of us getting snowed under. And what if Europe suddenly sees a massive drawdown in terms of natural gas supplies? We see another spike in terms of inflation here, but we maybe don't see that elsewhere. So, that's certainly going to be interesting to see that differential in terms of inflation and how that impacts people's perception on the FX markets.
It's interesting, this idea about going into recession, isn't it? Surely, Shaun, that would possibly hit this idea that we should be going into base metals. Base metals respond very well to growth, and if we're not going to get the growth, why should we be looking at base metals?
I think more than the dollar story, well, I like particular copper. If I was to choose between copper and iron ore, I'm choosing copper. It's the demand side factors there. So inflation does increase cost inputs. Most of the copper is coming from South America. It's quite far off to get from there to China, who's the primary importer there. So it still provides cost pressures, production pressures, but the demand will still be rising from China, who's stimulating the economy. They don't have the inflation problem at the moment. I think the last inflation print there is about 1.6. So the driver for on the base metal sides for me is more from China. We know they are the primary consumer. When you look at something like iron ore, I think 70% of seaborne iron ore is imported it goes to China, and China of that all that iron. I think it's 40% of that's used to make steel. If they are stimulating that property sector to try, avert, what has been happening, led by Evergrande, construction, infrastructure spend, it all supports those commodities. And it's almost like a self-sufficient economy where we're not dependent on exactly what's happening in the US and the rest of the world, for that demand for copper and iron ore.
What do you think, Shaun, in terms of what's happening in China? This whole decision to suddenly apparently just abandon the whole zero COVID thing. What happens if we see a massive spike in terms of cases? Do you think that they're going to lock down again, or you think this is them now? They've pretty much made the rod for their own back.
Well, that's the thing. It's not without risk, as we know. The last couple of years have shown us there's pressures come from all sides. But I think at the moment now they've opened up the economy, but government has recognized that Omicron variant is less lethal and doesn't require the same restrictions as before. So there is that messaging there. They haven't really changed policy all that much, but they have reduced restrictions at this point in time. So I think there is a threat of locking down again. However, what we've seen is that the people are now starting to stand up and starting to resist that, with the protest action. So I think if we do go into lockdowns, they become a lot more limited. There is definitely a move towards getting the Chinese economy going. And so, we're sitting at just over 3% growth in China. They need to get that back up to 4.5%, 5%. And they are committed to doing that because if nothing else, they need to, also just sort of support that property sector. I think the Chinese property market counts for, it has historically been 30% of the region's GDP. So it's all, so that is definitely a risk. A resurgence of COVID, and you're going to get a lot more infections. I think they will definitely hit more than the 250,000 peak that they have had, but 90% of the the country is now vaccinated. So we're hoping that this is just the start of continued easing of lockdown restrictions.
That's a really good point, Josh. I think the question you've got there actually could be fired at any one of us about next year. And I think, Axel, if I can ask you to answer that same question about how dependent are you on your ideas for 2023 to see China come back to some sort of normality in terms of their activity, their heightened amount of manufacturing. We've heard recently, of course, haven't we, all the difficulties that, for example, Apple has got with this Foxconn factory. They employ more than 200,000 people making iPhones. Look, there's a lot of supply chain issues coming out of China, and they may not be fixed next year. But how much of your idea that we're going to get a late resurgence in the equity markets is based on this idea that China ramps back up to some sort of normal speed?
Well, China will certainly play an important role in that recovery in equity markets. But having looked at what's happened in the region in general, in Vietnam, for example, a lot of the industry has now gone from China to these other countries with different COVID-19 policies. So maybe some of the demand will come from those countries going forward and not just from China. And in Europe, obviously, we also have to see, as Josh said just a minute ago, what will happen with regards to Russia and the Ukraine. And perhaps there's another black swan out there. Who knows about China and Taiwan? So all of these factors will basically have a huge impact on the economies of those countries. But that's why I also look at charts, because at the end of the day, for me, everything's in the chart, and the price action itself is very important to look at. And right now, it looks as if equity markets, at least medium term, so over the next few weeks to months, are more constructive than they have been over the course of this year. And I do think that we will be starting off the year on a positive footing based on that, basically.
What are your thoughts, Chris, about this big picture, the geopolitics of the world? We don't know where, of course, as we've been hearing, where Ukraine and Russia is going to end out, whether or not it's going to expand into other parts of Eastern Europe, heaven forbid. We just don't know. I know there's a lot of big questions out there. How do you see those big questions revealing themselves, if you like, to us traders, and how we should take part in an opportunity here, whether it's inflation, whether it's Russia, whether it's China? How do we trade this?
I think you see a shift further away from China as a manufacturing base. I think you can makes other emerging markets quite interesting, although risky, obviously, in the process. You can expect, I think, there's if you like, a growing Cold War with China in terms of semiconductors, most obviously, to put pressure on China, but others to become an increasing focal point. And I think that's something where investors may find the potential for some interesting opportunities further down the line. I don't think we're seeing, certainly that on the current performance, that it's unlikely that the Russian adventure in Ukraine expands any further, and essentially sort of contained them, if you like, most effectively through their own mistakes. I suppose the big risk to the US is what China does. Obviously, the Taiwan issue looms large, really, and unlikely to a direct action. It's more like a kind of political pressure applied to Taiwan to try and fall into line, and you can expect that maybe to lead to perhaps a further risk-off move, because so much of the current global economy is based on a harmonious relationship between the US and China, and China and the rest of the world. So if that starts to fall apart, you could see major, I think, issues, to say the least, developing there that, again, would pile in, to go back to the recession thesis, that would kind of pile into that and amplify the potentials for that as well.
Josh, do you see anything that's going to derail? What are the risks to your idea of seeing benefit in going long gold or long precious metals?
Well, I mean, look, just speaking in terms of some of the risks, this is the thing, and certainly this whole thing, as Axel was saying about China and Taiwan, that could be another whole crisis that could spark something else that at the moment markets, I guess, aren't really factoring in. I think going forward, if we look at, say, what's happening in terms of Russia and Ukraine, I think that maybe they just resolve it overnight. It seems very unlikely. But certainly, with China, what if China doesn't come back super strong, and what might that do in terms of the recovery, in terms of the stock market? Well, actually, I think in terms of China not necessarily coming back as strongly, and maybe that depressed growth here in Europe and the US, and it makes, certainly once inflation gets resolved, it makes the central banks even more keen to start easing monetary policy in a very dramatic manner. And subsequently, we see more benefit in terms of stocks. We see more benefit in terms of gold. So certainly, I think, if we're looking from the perspective of, where's monetary policy going to be moving? I think by and large, central banks want to be cutting interest rates. They don't want to be hiking interest rates right now. It's coming to the detriment of the economy, and that's no good for the polls. So when it comes down to it, as long as inflation is brought under control, that's going to be the most important thing. So certainly, if any of these sort of black swan events do end up seeing another major spike in terms of inflation, I think that is a big risk here. Is, what if we see a secondary spike in terms of inflation? That's what's going to once again derail markets, probably send the likes of gold and silver sharply lower once again. And certainly that is a major risk. What's to say that markets have now topped out in terms of inflation, or the economies have topped out in terms of inflation, and that's it? It's not necessarily going to be a straight line, I don't think. And the biggest sort of determinant of it has been energy markets. So, maybe we see as a strategic petroleum reserve starts gobbling up resources rather than putting them out into the market. Maybe we see OPEC push the button a little bit further. There's a number of different factors that could spark another move higher in terms of energy markets, and that is a big risk, because markets don't really like waiting around. And if they think they're on the cusp of another big surge in inflation, you know, all of a sudden this goodwill that we've seen within markets can come crumbling down pretty sharpish, and I think gold would go with it.
Yeah, look, gents, we've got to leave it there. One more final question, actually, for Chris as the chief market analyst. Your overarching thoughts, having heard what we've been talking about today for 2023. Clearly, there's a lot of threads to pick up on. But if there was one big message for IG clients going into 2023, what would you like them to be hearing and be cognizant of?
That 2022 was just the prelude, if you like, to more to come. Really, the sort of fallout, if you like, the changes in the post-pandemic world, a move away from a world of low interest rates. It takes time to digest and adjust to that, and I think we're seeing 2022 was the first stirrings of that. Really, the easy first move down. I think then it becomes a lot trickier from here, I think, to navigate. So you can expect volatility to be a given. Really, I think you can expect differences to emerge now in assets that weren't really that clear so far this year.
Good. Okay, look, we've got to leave it there, but thanks indeed for joining us. Chris Beauchamp, Shaun Murison, Axel Rudolph and Josh Mahony. Have a great Christmas and Happy New Year, and look forward to catching up with you again in 2023.